If I could break down the whole short-term rental game into just two things, it would be number one, get a property that essentially pays for itself with the tax savings. And then number two, add in the enhancements post-close to get that thing to cash flow. So when I started doing short-term rentals in 2021, this is exactly how I did my first two deals. My very first one I did with a partner. It was super, super low money down, and I took 100% of the tax savings. And then the second deal I did on my own, close to $830,000 in purchase price. I put 10% down, and then all in across both of those deals, including the design enhancements and the furnishing, I put around 140 to 50,000 all in on those deals. The cost segregation studies on both of those deals got me back right around 430 to 440,000 in total offset, or a total paper loss that I was able to apply against my total taxable income that year. The net effective tax savings on both of those deals ended up being around 120 to 130 grand for me in the first calendar year that I did this. So that was kind of how we came up with the reverse offset method, which was essentially the money that I put into those deals essentially solved for the same amount of tax bill that I otherwise would have needed to pay. So for example, instead of funding the IRS that year, I basically took that same or almost identical dollar amount and just put it into deals that I did either with a partner or on my own that first year. So then in 2022, the next year, I learned it's not all roses and sunshine. You can absolutely do this stuff wrong. So I took the exact same approach and I started doing deals just like I had done in the first year. So I did 3 deals with partners, 3 deals on my own. Those 3 deals that I did with partners, we did have the capital to go in and put in the post-close enhancements, the interior, the exterior design. So things like the mini putting greens, the hot tubs. At the time, I was having a very different approach versus what we teach clients to do now. But I did have the capital because I also had those partners who were doing the deals with me. Well, in that same year, I did another 3 deals. I did them completely on my own. I was stretched thin. So I didn't have hundreds and hundreds and hundreds of thousands of dollars to deploy. I barely had enough just to put down the down payment and the closing costs for those deals that I did on my own. So in 2022, I had 6 deals. I had 3 that I did with partners, 3 that I did on my own. And guess which ones ended up cash flowing and which ones ended up not cash flowing? Exactly. The ones that I did with partners cash flowed. And the reason was because we actually added in the enhancements. The 3 that I did on my own, they did not cash flow. And it was very painful and aggressively difficult to go back 3, 6, 9, 12 months later and slowly, as my budget increased, add in those enhancements post-close. So this is why we feel that we've come up with the blueprint. And after 300 closings over the last few years, fortunately, I had that moment where I learned, hey, it's hitting me like a ton of bricks. Like my homes are not performing because I skipped this fundamental step. I thought it was just finding the right deals in the right submarkets and then just plugging in a proper co-host. And that was pretty much everything you needed to do. That was not the case. I certainly learned the hard way. And then ever since then, we've had the blueprint dialed in for clients where it's finding the right properties in the right homes, negotiating the best deal possible, which for a lot of clients right now, it's literally just getting the largest seller credits that we can possibly get because the homes will typically underappraise. So we get to win twice that way. And then post-close, so now that we've got a home that is essentially paid for itself or gotten very close to paying for itself, where instead of taking that 130 that you might have funded the IRS and your state and your inefficient state government, Department of Revenue, you'll now be putting that into the down payment and the closing costs of the home. And then you might have an extra 15, 30, maybe even 40, 45,000 of budget that you want to put into the backyard and to the interior, maybe even hiring a designer to redo some of the design and the furniture stuff inside. And now you've just acquired an asset that is basically paying for itself the moment that you bought it and now paying for itself every single year with the cash flows. So now your guests are the one who are paying down your mortgage, your utilities, all your operating expenses annually, and you get cash flow and a little bit of a surplus so that you can use that to basically go fund future deals. Or what's more likely is you're probably just going to, in 2, 3, 4 years down the line, get an appraisal. And once the home has gone up significantly enough in value, that new home value will qualify you for a loan, typically 70, 75, 80% of that new value of the home. And you can go and get a loan, pay off your existing debt, and use that extra 50, 100, 150, 200,000, depending upon when you refinance the home, to go and fund your future deals. So this is essentially that snowball effect where 3, 4, 5, 6 years down the line, once you've been doing this long enough, you're now using the funds from deals that you purchased 2, 3, 4 years ago to fund the deals that you're doing right now, which is why we suddenly have clients who've now been doing this for 3+ years. We had a couple clients who actually managed to refinance on a home that they purchased 3 years ago, and they're now using the funds from that deal to fund their deal that they're doing today. So they didn't even come out of pocket to use their own money to fund their new purchases. They basically used the money that was sitting around in their old property, funded that deal this year, and now they've taken care of their tax bill and they have that extra 100, 150 grand to deploy into whatever else.